Hey guys, welcome back to Invested. Good question on 1031 and Opportunity Zone, OZ Fund. So I thought I'd take this question and answer it for the viewers here. Considering selling a triplex, reinvest in 1031 or OZ Fund. We have triplex we have owned for over 10 years. It's performing well, but with property tax in Texas and eventually high capex, which is capital improvement, coming up, we're thinking of selling. Would you put your cap gains into triple net property, cap rate around 7 to 8% maybe, or OZ fund? We could pull about 300,000 out of it, but the cap gain would be about 200K. I want something very passive. I guess other option would be to pay the cap gain tax and just put it into the stock market. Good question. So this is something that it's very technical in the real estate world to defer or mitigate your tax exposure, right? Because at the end of the day, if you listen to Robert Kiyosaki, it's about taxes and debt. So that's true to some degree. I don't completely agree, but it's a good start. So wanted to kind of highlight two things, 1031 exchange and OZ fund. I think a lot of real estate investors understand 1031, but I think the opportunity zone is something relatively new within the last 6-7 years. So there's no track record. A lot of the OZ funds that started 3-4 years ago, they're still in their investment period. So we don't have the market or the general private equity world, and a lot of people don't really have good track record of how opportunity zone funds or real estate will perform yet. So I'll highlight two things for you to make sound decision for you. So number one, in 1031 exchange, your capital gains are deferred in perpetuity. But if you sold everything, all your money has to go into your replacement property. So your sold property, we call your down leg or your relinquished property. All the proceeds from that has to go into escrow to a 1031 administrator. And once you find your up leg or replacement property, all that money has to go in. You can't take a dollar away from it because you're going to have something called a boot. And you don't want to do that because that will trigger the capital gains tax on you to a certain degree. I'm not a tax advisor, so you should consult your tax accountant who should know this a little bit better for you, understanding your full tax ramifications with your income and all the different things. So you have to move everything and it has to be like kind. So if you're selling a triplex for investment, yes, you could put it into a triple net property. And 78% cap rate, that's pretty good. Just make sure you vet the tenant and the credit. Like for instance, if you're buying Dollar General, AutoZone, McDonald's, Jack in the Box, Starbucks, you're good. But if you're going into Charles's Burger Shop, I don't know. There's certain risk with the credit tenant, which is Charles, which I have nothing. So there's no credit. So you want to be mindful of that. And it's going to be really passive because most triple net property are usually absolutely triple net. So the tenant pays for the rent, the ground lease or the rent, property taxes, insurance, and the maintenance of the property. Now, going into OZ fund, you specifically said fund. So it's going to be a sponsor who handles the opportunity zone placement for you. So it's not only you. They might have like 100 investors and they all come together and they buy, let's say, $150 million property, multifamily, which you'll never have access to or not right now in capacity. So then you get to put in your small investment into a larger deal because you have multiple investors coming in, you have a sponsor. But in that situation, OZ fund, you could keep your principal and you can only put in your capital gains. So as an example, if your original basis was $1 million and you sold it for $2 million, you could keep $1 million of your original principal. You could take that back without any tax ramification. The capital gain will be on the $1 million of profit. That can go into OZ fund. But OZ fund, especially funds, is passive, but there's a lot of fees associated with it. So because most OZ funds are developments, there's certain requirements and rules around the OZ fund or OZ qualified opportunity zone asset or areas. It's going to be mostly heavy repositioning, meaning heavy construction work. So a lot of the people will do a ground up development. So their usually goal is they put in, they build it, they stabilize it, and they refinance that project in year 3 or 4, and they give some money back to the investor. And the reason why they do that is because you're going to have your tax liability 3 to 4 years after you sold the property. So that's a way to get that money back to pay your taxes. And OZ fund and OZ properties, if you hold that property for 10 years and it's qualified OZ, then all the capital gains you make is going to be tax-free from a federal level. So that's the big kicker and the big icing on the cake why people like OZ funds. So they're both very passive. I think the 1031 triple net lease property, you have a little bit more control versus going into a discretionary fund that has a lot of fees because they'll take acquisition fee, legal fees, construction management fee, property management fee, refinancing fee. So at the end of the day, I mean, the sponsors, I'm a sponsor myself, but they make a lot of fees. So the clear winner is going to be the sponsor because they're going to make a lot of fees in between the 10 years. And they usually return metrics are going to be a little bit muted or similar to a value fund. So it's really to your discretion, your hold period. Because OZ fund, like I said, you got to hold for 10 years. So let's say 10 year plus one, so 11 years. And triple net property on 1031, long as you hold it for 2 years as an investment, then you could repeat that cycle again. So you can sell that 7, 8 cap triple net property after 3 years and do it again and continuously defer your capital gains. So a lot of people seem that to be more attractive, but OZ funds are going to give you some opportunity to go into larger projects that you may not be able to do it directly yourself. So those are the pros and cons with it. Stock market, stock market. It's a very liquid market. And if you have a good track record, I mean, you could do that as well too. And since like you're a savvy real estate investor, there's two different components, right? If you put it into the stock market, all your capital gains, it's not sheltered. You're going to have to pay for that, right? Eventually when you sell the stocks. But in real estate, you also understand there's something called depreciation. So optically, depreciation is not a cash adjustment. It's just adjustment on the bottom, right? So from a tax basis. So you get that benefit through your hold period too. So there's a slight kicker there. So you should kind of weigh that out to make it to apple. And hope this information was helpful for you to make that determination. If you found this content helpful, please like, subscribe, and add us comments. Thank you very much.